Hello and welcome to Pro Trader Strategies Market Commentary for Wednesday, May the 25th. My name's Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal, where I've commented on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these daily market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies that you can implement into your own portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios. Therefore, what I'm doing could be counterintuitive to what you are already doing. Having that out of the way, let's get this on. Not a whole lot of economic data today, but we did get flash services PMI, and that came in at 51.2, but was expected a little bit higher at 53.1. So above that 50 that we always talk about, which signals expansion. Anything below 50 would be a contraction in the economy, or recessionary, if you will. We also got overnight crude oil supplies, which came in at a drawdown of 4.2 million barrels. It was only expected to be a drawdown of 1.7 million barrels. So having said that, as you can see here on the chart, /CL, which is light sweet crude oil futures, pushing higher today up against the resistance area that I talk so much about on this market profile, which is the value area high, and it's right there at $49.50 a barrel. So we are right on it. Anything to settle above that will signal that the bears are pretty much, or the bulls are in full control. The bears are on their heels, and I might step into the water if we get up here into this $50 a barrel range, because I believe that it's going to just want to continue to rally, and maybe rally up to the 60 area. So I may be stepping in if it continues to push much higher at all. Onto the E-mini, or the E-mini NASDAQ futures /NQ, up 35 points on the day, slightly off the highs of the day. It was up 40 some odd points earlier. You can easily see us wanting to trade up into this area that I talked about. It looks like it's a pretty easy target, at least for tomorrow, up to 45.15 area. So that is going to be the next area where there's a comfort zone. And then I could easily see, like I said, filling in this darkened area to create a nice big bell curve. So this could be our next consolidation area. Under the E-mini S&Ps, as soon as we got above the point of control right here, we just blasted higher this morning, and are now testing the value area high, as we saw the same in the NASDAQ. So that's going to act as resistance, but anything pushing above that is going to allow these E-mini S&Ps to shoot higher. One other thing about this is, I even talked about this in the timing research show, that we were consistently seeing lower lows and lower highs going throughout. Now this has really really broken that whole, what people were talking about is the head, or the head and shoulders. Here's one shoulder, the head, the neckline, and then the next shoulder. Now once we broke below that, it looked pretty good that the bears were going to be taking this down, but the bulls came out of the woodwork and pushed this market higher. Now a head and shoulders pattern is much more powerful when it's at the top of a pattern, or a topping pattern, which this is not. So not really unlikely that that was going to get broken. A lot of people were hoping, I myself was hoping that this would stay intact, but at this point it looks like it is broken, and the bulls are well in control of this market. Onto the E-mini S&P's daily breakdown. This is on the 15-minute chart. As you can see, overnight session, the market really just trended higher, and as soon as the market opened, we saw that flash PMI number come in a little bit lower than expected. Could have been a catalyst for people to think that the Fed was not going to go. And then again, with crude oil inventories having that drawdown, that brought the overall equities higher as well. So that gave them an extra boost to move higher, which is right in this area as well. So crude oil moving higher off of lower inventories is signaling there's definitely some demand out there, especially at these price levels. So although there is a huge glut of inventory out there, which I showed yesterday's market commentary, this drawdown, consumers are continuing to use the black gold, if you will. Onto some things that I've done with this Apache. I went in there and I decided to build something with this low implied volatility market that we're seeing. We're going to continue to see that, it looks like, especially if the markets continue to rally. That's going to be an opportunity to start doing some spreads that I don't normally do, which is the debit spread. But I'm going to be trying to at least finance them with selling something around them. And in this regard, I did the July-June 52.5, 60.5 call calendar. And it's really a diagonal. It's a diagonal calendar spread, if you will. So if you think of it, it's a vertical is a vertical chain inside of 1 month, and a diagonal, which is two different strikes in various months. So in the July, I'm buying the 52.5 calls, which is the longer duration one, and I'm paying a little bit more for that, but I'm going to try and finance at least the extrinsic value that I'm seeing in that option by selling the June 60.5 calls. So all in all, I paid $5.91 for that. So I was able to finance the extrinsic value. So for all intents and purposes, the $5.91, if you added that into the $52.50 calls, then that puts us very close to where the underlying is trading. It's kind of similar to a poor man's covered call, but we're going shorter duration and we're not going as deep in the money for the long call. What we're trying to do is just create about 75%. We're trying to pay less than 75% the width of those strikes. So it's an $8 width on that strike. I basically paid $6, let's say. So that's right around 75% the width, which is just the opposite of what I talk about when we're talking about building a strategy around credit spreads. We're trying to collect around 33 to possibly 25% the width of those strikes. This is the opposite of that. We would like to pay about 50 to 75%, no more than 75% the width of those strikes. And you got to be really careful with this strategy, and it takes a little bit longer legwork to find the right trades with this, because you could easily pay over the width of those strikes. You could essentially pay $8.10 for an $8 wide strike, so, or an $8 wide width on those strikes. So keep that in mind when you're doing these and implementing that. But there's a lot of things that go into this one. There's a lot of nuances with it. So go to protraderstrategies.com and sign up for this Friday's webinar, because we're going to be doing this diagonal spread, an hour-long webinar on all the nuances that are associated to it, because there is a long list of them. So that's all I got for you guys today, other than if you can't take that, take it easy.